Well, good morning or good afternoon, depending on what time zone you're in. On behalf of Sikich, we'd like to welcome you to our webinar on Governmental Accounting Standards Board Statement number 87, simply titled Leases. You know, some GASB pronouncements have very lengthy titles, but GASB stuck with just one word for this in Leases. I wish the actual body of the pronouncement was as simple as the title that they have, but you'll find that the actual body of the pronouncement is a little more verbose than what the title is. So we have a wealth of information that we're going to share with you over the next hour, including some great examples as to how your government can apply this specific pronouncement to some specific transactions that you may enter into. Believe it or not, we have over 100 participants in this webinar from all across the country. And we have participants from all governments of all shapes and sizes, from general purpose governments and some very large ones to special purpose governments. In addition, we have folks that are serving in a variety of capacities, from chief financial officers to accountants and to bookkeepers. Our goal for today is going to be assisting you in understanding the basic philosophy of GASB Statement number 87 and how you can apply this pronouncement to, again, some of your specific situations. In order to do this, we're going to be using a lot of slides today. If you want copies of the slides, in your handout section, you should be able to download the slides now. Once we conclude the presentation, you will get a link with a copy of the webinar, a copy of the slides in PDF form that you can download, as well as an evaluation form. Both of the instructors for today are very comfortable addressing questions throughout the presentation. If you do have a question, we just ask that you type it into the chat box, and we will do our best to address the question sometime throughout the presentation. If we're not able, due to time constraints or other constraints, to respond to your question during the presentation, we'll do our best to follow up with an email to you. So thank you all for, when you registered, for leaving us your email address so we can follow up with you if necessary for a particular question. Who will be presenting today on behalf of Sikich LLP? We have two presenters today, assuming I can get my slides to work. There we go. And we'd like to take a moment to introduce them to you. First is myself, Fred Lantz. I'm a partner in charge of government services here at Sikich, and I apologize if I sound a little congested or a little nasally. I came down with a sinus infection on Mother's Day and have been struggling with it the last couple of days. But that's the wonderful thing about a webinar, is you all can't see how bad I look, and I can still do the presentation without infecting you all. I'm only going to be infecting the poor people in the room with me today, but fortunately, I've been on penicillin for the last 48 hours, so hopefully I'm no longer contagious. So. I've been with Sikich now for about 26 years, and I lead our state and local government practice. I work with some of the largest governments in our area, such as the state of Illinois and the city of Aurora, down to some of the smallest governments in the region as well. Almost every government I've worked with will be impacted by GASB Statement 87 in one way, shape, or another. Prior to joining Sikich, I was the Assistant Director of the Technical Services Center at the Government Finance Officers Association, where I managed the Certificate of Achievement for Excellence in Financial Reporting program, and was fortunate enough to serve as one of the GFOA's liaisons to the Governmental Accounting Standards Board. As a liaison, I attended monthly GASB board meetings and testified before GASB on due process documents. If you want to talk about some real fun and exciting meetings to attend, think of sitting through 8 hours of deliberations for 3 or 4 days straight on actuarial valuations and accounting for pensions, or even better, sitting through a few days of deliberations and accounting for leases. When I first started with GFOA, they were the MFOA at the time, the Municipal Finance Officers Association, and we were staffed to the National Council on Governmental Accounting. And you might recall the NCGA was the predecessor to our current standard-setting body, the Governmental Accounting Standards Board. The first pronouncement that I worked at when I was at GFOA, believe it or not, was NCGA Statement number 5, Accounting and Financial Reporting Principles for Lease Agreements of State and Local Governments, which is the first standard that we had on leases specific to the state and local government industry. While much of that standard has been superseded over time, some of the founding principles of that standard still remain applicable today, especially one of my favorite components of that pronouncement, the fiscal funding clause, noting that we build fiscal funding clauses into all of our contracts and lease agreements that basically say that if our governing body does not appropriate to pay this in the future, we don't have to pay the lease and can back out of the lease. Again, Statement 5 said, well, if the likelihood of you enacting that fiscal funding clause is remote, then we should ignore the fiscal funding clause from an accounting and reporting standpoint. And that carried through now today into GASB Statement 87. While serving as a liaison to GASB, I sat through their deliberations on GASB Statement number 13, accounting for operating leases with scheduled rent increases, which was GASB's first foray into the overall lease guidance. Now I can come full circle and talk about GASB Statement number 87, which supersedes NCGA Statement 5, as well as GASB Statement number 13. I'm so excited. I hope you all are too. With me today is Anthony Cervini. I'm going to turn it over to Anthony now to introduce himself.
Thank you, Fred, and hello, everyone. Again, welcome to our webinar today from wherever you may be watching. My name is Anthony Cervini, also a partner here at Sikich LLP, and spent my entire 15-year career here at Sikich working almost exclusively with units of local government with a similar range and size and scope of clients to what Fred has worked. Excited for our topic today, excited to go through some of the examples that we really feel will be relevant for you and your organizations on that. And with that, I'll turn it back over to Fred to go over a few more logistical items.
Thank you, Anthony. And hopefully you've all found the chat box and are comfortable in typing questions into us in the chat box. Looks like we haven't received any questions from anybody about not being able to connect or not being able to hear us. So it looks like we're in business and ready to get started. Wonderful. I know a lot of you are probably on board today for the continuing professional education credit. Nothing wrong with that. We're very proud to offer complimentary continuing professional education credit to all of you online today. For those of you who do want to receive CPE, there's certain rules that we have to follow today. First and foremost, this does qualify for 1 hour of continuing professional education credit. And more importantly, it does qualify for Yellow Book CPE, the best form of CPE we can receive, because a lot of us do need CPE in accordance with the Yellow Book or generally accepted government auditing standards. To qualify for both the Yellow Book CPE and the regular CPE, you do need to demonstrate that you are following along with the presentation today. In order to do that, you need to answer 3 polling questions that we will ask throughout the presentation. You do not have to worry about answering the question correctly, just answering the question qualifies you for CPE. So please, whenever you see one of those polling questions pop up on your screen, do take a moment and go ahead and answer the question. And again, don't worry about answering it correctly, just provide some answer within the time frame so that we can determine that you are actively participating in the webinar to receive the CPE. After the webinar, we will send you a survey to complete. If you answer the 3 polling questions and complete the survey, we will send you a CPE certificate as evidence of your continuing professional education credit and completion of this webinar. Also, as I noted previously, we will send you a link for the recording of the webinar, a PDF of the slides, as well as that survey to complete. Any questions before we do get started then? No, it looks like everyone is online and ready to go. Hopefully you all are having lunch and sitting back and having a nice little bite to eat while we go through this. Remember, to qualify for CPE, you should be having chicken for lunch today because you're required to have chicken for all continuing professional education courses. So I know that's just a joke on my side. So, okay, what are we going to cover today? The topics we're going to cover are the burning questions that you see on the screen today and the burning questions that you probably have as signing up for the webinar. First and foremost, we're going to cover what is defined as a lease under the new guidance. And trust me, this is very, very different than what we might have learned studying for the CPA exam, maybe 35 years ago when I first sat for the exam. How to determine the terms of the lease to base the accounting and reporting decision on, because the overall arching principle is the lease term and determining what the lease term is to accurately then report an asset or liability resulting from that lease transaction. We'll then go through some examples of how to account for a lease from both a lessor standpoint and a lessee standpoint, as many of your governments will have both of those. And also, we'll look at how to account for the lease transactions, both from a lessor standpoint and a lessee standpoint, in both your governmental funds as well as in accrual-based funds at the entity-wide level, because the accounting and reporting is a little bit different for those, depending on if you're on the lessor side or the lessee side, because of the different measurement focus and different bases of accounting that we apply to those different scenarios. We'll also cover how to account for the requirements of a short-term lease and what the definition of a short-term lease, because I can guarantee you many of us, once we go through this, will say, how can I get out of applying GASB 87? Can I deem all my leases to be short-term leases and therefore have an out? GASB took a preemptive strike on us, so we'll have to go through that and see whether or not we can meet a requirement of a short-term lease. And then time permitting, we might cover accounting for lease incentives, lease modifications, and lease terminations. So the first question that most of you probably have is, Fred, why are we having to deal with this, and when do we have to deal with this? Well, GASB issued Statement 87 to improve the overall lease accounting and financial reporting. At least that's what they tell us. And I certainly agree that we did have some holes from an authoritative literature standpoint, and a lot of transactions that weren't addressed either by NCJ Statement 5 or GASB Statement 13, or subsequent to that, GASB Statement number 62. So Statement 87 then was issued to address a number of the accounting and reporting issues that have developed since the implementation of those other pronouncements, especially related to the definition of an asset and the definition of a liability that was contained in GASB Concept Statement number 4, Elements of Financial Statements, and GASB Concept Statement number 6, Measurement of Elements of Financial Statements. In my opinion, those two concept statements have really driven this project more than anything else, because the new definitions that they came up with in those concept statements, and the fact that those concept statements were issued much after NCGA Statement 5 and much after GASB Statement number 13. In addition, both the Financial Accounting Standards Board, known as FASB, and the International Accounting Standards Board, known as IASB, conducted joint research projects on overall lease standards, and together they developed revised guidance that hopefully will simplify the accounting and reporting for leases. Believe it or not, FASB had over 32 pronouncements between statements, interpretations, technical bulletins, and other guidance on accounting and reporting for leases. Removed professional judgment completely from the accounting. They've now simplified this both on the FASB side and the IASB side with a simple professional-based judgment on what is a lease and how to apply the criteria. So to a certain degree, those two standard-setting bodies did drive GASB's agenda to undertake the project on leases, because there were going to be significant changes coming up and significant changes being implemented right now in those industries that certainly would cause confusion in our industry if we did not address some of those differences. GASB has conducted their own research over the last 4 years and concluded that with new guidance, which was needed, and culminated with the issuance of GASB Statement number 87 in June of 2017. Fortunately, the Governmental Accounting Standards Board provided a lot of lead time for us to implement this complex pronouncement. When is it effective? Statement 87 is first effective for fiscal years beginning after December 15th, 2019, which in our terminology is for fiscal years ending December 31st, 2020 and thereafter. So if you're an April 30th year end, a June 30th year end, or a November 30th year end, your effective date will be your 2021 fiscal year end. Excuse me. Those of you with the June 30th fiscal year end, you're probably appreciative of this December 31st implementation date, because the 12/31 or the calendar year ends get to be the guinea pig this time instead of the June 30th year ends, because it seems like GASB usually picks a June 30th year end to first implement these new standards. Now, those of you who are sitting back and probably thinking, well, Fred, I don't need to worry about this new pronouncement. If I'm a 12/31 year end, I have 6 months to worry about it. If I'm a April 30th or June 30th year end, I have over a year to worry about it. But if you think about it, if you're a December 31st year end or an April 30th year end, you are already past the starting point of when you need to apply GASB Statement 87 to all lease agreements, because GASB 87 requires us to implement this as at the beginning of the year, in the year that we go to implement the pronouncement. So if your implementation date is December 31st, 2020, then you need to account for all leases as of the start of the year to the end of that period. So again, we do need to start tracking this information now in order to have a very, very smooth implementation 1 year down the road from now. In addition, GASB just released an implementation guide, a draft of an implementation guide, what we call an exposure draft, that will assist us in implementing GASB Statement number 87. The comment period on the exposure draft ended as of April 30th, 2019, and in reviewing some of the information on GASB's website, they received over 30 comment letters on that exposure draft, that implementation guide. We originally anticipated a final implementation guide to be voted on and issued perhaps by June, and maybe issued in early July, a little something, some light reading for us just in time for the 4th of July holiday. Now, because of the number of comment letters that they received, it looks like it probably will be late July or early August before they do vote and continue their deliberations, and then vote on the issuance of that revised implementation guide. So that is something to look forward to in the future. I've gone through the implementation guide in detail, and I can't encourage you enough to take a gander through it. It really has some great information, and more importantly, has some great examples as to how we can apply this pronouncement to some of your specific transactions. Okay, let's talk about the overall scope and approach of GASB Statement 87. First, I guess, what is a lease as defined now by GASB Statement 87? Basically, the new pronouncement removes the previous criteria for determining a lease and instead focuses on the existence of a non-cancelable contract that results in an asset to the lessor or a liability to the lessee. And that really is the key component there, a non-cancelable contract. So you may have a contract that is not titled as a lease and is not called a lease, but yet may be subject to the guidance of GASB Statement 87 on a lease transaction. In addition, you may have something called a lease, such as a certificate of participation. And this is where I coined one of my favorite comments, that you can paint the cow green and call it a frog. Even though it might say master lease purchase agreement on the front of the certificate of participation, that's really nothing more than a note transaction and should be accounted for as that. So we really have to overlook how a particular contract is titled, whether it's titled as a lease or not, and instead look at the substantive form of the contract to determine whether or not GASB Statement 87 is going to apply to that. So what is that definition now of Statement 87? Well, we do have that up on the screen for you. A lease is a contract, a non-cancelable contract, that conveys control of the right to use another entity's non-financial asset, what we call the underlying asset, and that's very important. Another entity's non-financial assets. That means some type of capital asset for a period of time in an exchange or an exchange-like transaction. A couple of key components to note there, and this was clarified also in the implementation guide, that doesn't mean that your lease is for the constant period of that asset. For example, if you're a school district or a park district and you're leasing portions of someone else's facility only for a few days a week, but not the entire week, that could still meet the criteria of a lease as defined by GASB Statement 87. So it doesn't have to be a continual lease of every day of the week. Instead, the key is, do you have the right to control or use that non-financial asset for a period of time in an exchange or exchange-like transaction? It's really the key definition. Now, when we say exchange or exchange-like transaction, a lot of us have leases for a nominal value. We lease a building to the Historical Society for $1 a year. We lease land to a school district for $1 a year, whatever it might be. GASB states right in the pronouncement as well as in the implementation guide, those are what we call non-exchange transactions. Non-exchange transactions are not covered by GASB Statement 87. Instead, we would apply GASB Statement 33 to those non-exchange transactions. So any leases that have just a nominal value to them, again, we are not going to treat as an exchange or an exchange-like transaction, and instead apply different guidance to that. Examples of non-financial assets from the pronouncement would include items such as buildings, land, vehicles, and equipment. The guidance is very similar to the FASB guidance, but it's based on the notions of control found in concept statement number 4 from GASB, elements of financial statements. And those include the right to obtain the present service capacity from the use of the underlying asset, and the right to determine the nature and manner of use of the underlying asset. If you control those criteria, they would be applied to the right to use asset, and you would meet the requirements then of GASB Statement 87. So again, any contract, whether it's called a lease or not, that meets this definition should be accounted for under the leases guidance unless it's specifically excluded by Statement 87. I apologize for the coughing. In the final deliberations, the board decided to specifically note that the right to use a non-financial asset refers to the right to use another entity's underlying asset. They also decided that the right to use that asset should be what is specified in the contract, which again includes the right to use the underlying asset for only portions of time during a day or portions of time during the lease term. So again, we would meet that criteria. The board also agreed to add guidance for determining when a lease contract conveys control of the right to use an underlying asset. The board agreed that, unlike FASB, the criteria would not limit a lease to contracts that convey substantially all of the present service capacity from the underlying asset. So again, you can contract just for a portion of the service capacity of that underlying asset. Again, using that example I just went through. And it would still meet the requirements of a lease under GASB Statement 87. So again, it's a little different than what we're seeing on the FASB side and the commercial side. Now, these little subtle differences, in our opinion, may impact a lot of higher education, college and universities, a lot of school districts, and a lot of park districts in the country that rent out portions of their facilities over time, but only for certain times or certain days of the week. In any event, the key criteria that we're really focusing on is leases are financings of the right to use someone else's asset, and that gives us the single approach now to defining what is a lease. How many of you still have memorized the criteria for determining if a lease is an operating lease or a capital lease? I unfortunately still have that burned in my memory from the early 1980s from when I sat for the CPA exam. So if one of you would like me to repeat it, let me know and I can go ahead and repeat that for you. I'm sure Anthony can do the same. The good news is We can now wipe that out from our memory banks, as GASB Statement 87 no longer distinguishes between operating and capital leases. Instead, they focus solely on a non-cancelable financing arrangement. Now, Statement 87 does exclude certain transactions and contracts from its guidance, both from a lessor standpoint and a lessee standpoint. Specifically, first and foremost, GASB excludes short-term leases, as we'll define in just a minute, from the overall guidance of Statement 87, and we do have separate guidance under Statement 87, very, very short and sweet, on what we call a short-term lease. In addition, a lease or a contractual arrangement that effectively transfers ownership of the asset at the end of the agreement is not defined as a lease under GASB 87. So if at the end of the lease term, title to the asset automatically transfers to you, the lessee, we're not going to consider that a lease. Instead, that's just an installment purchase contract, and we should account for that as an installment purchase contract, no difference than issuing a note payable to acquire a capital asset. Certain exceptions also apply from the lessor standpoint. Specifically, leases of assets that are classified as investments under GASB Statement 72 are excluded, but are required to provide certain note disclosure related to those transactions. An example of that would be a pension fund that owns a building for investment purposes that then leases that asset for investment purposes. The lease of that asset, since it's not defined as a capital asset, but instead an investment to that pension fund, would not apply the requirements of GASB 87 to that lease transaction. In addition, there's certain leases that are subject to external laws, regulations, or legal rulings, and those may be exempt from guidance if the specific criteria of paragraph 43 of Statement 87 are met. For example, the U.S. Department of Transportation and the Federal Aviation Administration regulate aviation leases between airports and air carriers and for other aeronautical users. Those types of leases are excluded from the requirements of GASB Statement 87 and has additional guidance related to those. In addition, that would not include, though, leases for non-aeronautical uses, such as food courts and other items like that within the airport. So again, it's only going to apply to aeronautical uses, the actual gates and hangars and things of that nature. What else is GASB excluded from Statement 87? They also excluded intangible assets, such as mineral rights, patents, softwares, and copyrights. All of those have been excluded, except to the extent you have a sublease related to those. So the sublease of one of those would be included as part of GASB 87. In addition, biological assets are excluded based on feedback from a number of governments that own or operate zoos that lease animals for their exhibits. And this again was specifically covered in the implementation guide about excluding the leases covering, and I believe the implementation guide used lions, tigers, and sheep and other animals as part of their examples. So, in addition, some of us might have inventory on consignment, a transaction that might appear to be a lease, but that meets the definition of something else, and therefore we're not going to apply GASB 87 to it. In addition, we may have a transaction that would meet the definition of a service concession arrangement, such as the lease of a parking facility to a third-party operator where they control the operations of that parking facility. If we meet the requirements of a service concession arrangement, we would apply GASB Statement 60 to the transaction and would not apply GASB Statement 87. For those of you that have been in the conduit debt market lately, you know that those transactions, such as industrial development revenue bonds or industrial revenue bonds, contain leases as part of the overall agreement. Again, GASB said those are excluded from Statement 87, and instead we will apply guidance on conduit debt that GASB is currently working on and will come out within the not too distant future. The last exclusion I know will impact many of our clients and many of you all with utilities, whether it's a water utility or electric utility or other utility, or you have what's known as a take-or-pay contract or a contract to purchase electrical power or water over a long-term period. If you're only purchasing the power or the water, those are excluded from GASB Statement 87 and are not considered to be leases. If, however, you actually are leasing a portion of the facility that generates the power or purifies the water, in that case, the underlying asset, then yes, in that instance, you would apply GASB 87 to that component of the transaction. Okay, what is our exception for short-term leases? And I know everyone wants to try and meet this exception now because we don't want to have to apply the requirements of GASB Statement 87 to all these contracts we have outstanding. So for the definition of a short-term lease, and this is very important, at the beginning of the lease, So the beginning of the lease, when you go to sign that lease agreement, the maximum possible term under the contract is 12 months or less. GASB has chose the maximum possible term rather than lease term because they were concerned about the potential misapplication of the lease term guidance to manufacture short-term leases, thus avoiding recording assets or liabilities. And they have a specific example of this in the implementation guide, where a government enters into a 1-year lease, a 12-month lease, but that intends on executing a series of 1-year leases for the next 49 years. GASB said that clearly does not meet the definition of a short-term lease because the maximum possible term under that example is 50 years, not 12 months. So again, the maximum lease term has to be 12 months or less in order to meet this definition. In discussing this with Anthony, I know a lot of our clients have farm leases and they lease out some of their property to farmers until they find a use for it. If those leases cover just the current growing period, less than 12 months, then those would be excluded from recording a long-term asset or long-term liability related to this. If, however, you have a 3-year agreement with a farmer to lease your property to them, in that instance, even though the lease is only for the growing period, because it's for a period greater than 12 months, we would apply the requirements of GASB Statement 87 to those. Hopefully that clarifies that subtle difference between those two. So do not try to change your leases to a series of 11-month leases with extensions or renewal clause. GASB has already closed that loophole for us before it was even open.
This is really, Fred, a substance over form in terms of how GASB looked at the short-term lease guidance on that and how leases are structured for that. So in terms of, as you're reviewing those leases and working with your auditors on the implementation of GASB 87 for that, you will take those into account.
Perfect, thank you, Anthony. So if the contract meets the definition of a short-term lease, what do? All we do is recognize the expense or expenditure based on the terms of the contract, and we do not recognize an asset as a result of the lease. Likewise, from a lessor standpoint, we recognize revenue based on the contract, and we would not recognize a long-term receivable or a deferred inflow from the transaction unless rent was owed to us at the end of the year that we had not yet received for that particular period. From initial reporting, this is what we're going to follow, and this is where Anthony and I say, please do not shoot the messenger. This will significantly change how you previously accounted for lease transactions, especially for operating leases. Capital leases, most of those are going to go away now and become installment purchase contracts because of the transfer of ownership at the end of them. The operating leases is where this really is going to impact most state and local governments. So once we've determined that we have a non-cancelable contract, notice I don't use the term lease, but instead contract, that meets the definition contained in GASB Statement 87, this is how we're going to account for the transaction at the inception of the lease. In the year we implement Statement 87, we would not go back to the inception of the lease, but instead we would record this at the beginning of the year for the remainder of the agreement. So again, if we implement as of December 31st, 2020, as of January 1st, 2020 is when we would make these measurements for what's remaining on that contract as of that period of time. Notice we've broken this down between the lessee and the lessor. So let's start with the lessee. From the lessee standpoint, you're going to recognize a liability generally for the net present value of the future minimum lease payments, offset by an intangible asset, the right to use the asset underlying the lease. Big difference from where we are today in terms of you've never recorded any type of asset related to an operating lease. But now if it's a non-cancelable lease, so the key is non-cancelable, you have a long-term liability, so GASB wants you to record that long-term liability. The question is then, well, if we have to record long-term liability, we need some type of asset to offset that by, and that's where the intangible asset comes in, the right to use the asset underlying the lease agreement. From the lessor standpoint, we'd recognize a receivable generally for the net present value of the lease, offset by deferred inflow of resources, should be unearned revenue in my opinion, but GASB disagreed with that, so we'll go with the deferred inflow of resources. Generally, that's going to be equal to the receivable plus any cash received up front that relates to future periods, such as a cell tower lease where the lessee pays a portion of future years' rent in year one or at the inception of signing of the agreement. So there may be many instances where the lease receivable will not equal the deferred inflow. The deferred inflow may actually be greater if we received any upfront payments as a result of that. Now you're probably thinking to yourself, great, Fred, where are we going to record these? Well, we record all these transactions on financial statements prepared under the accrual basis of accounting and the economic resources measurement focus. So basically the entity-wide financial statements, proprietary financial statements, and fiduciary fund financial statements. And governmental funds are funds using the current financial resources measurement focus. On the lessee side, we never record the long-term liability or the intangible asset in a governmental fund that violates that current financial resources measurement focus. Instead, that long-term liability and the intangible asset would be recorded probably in our conversion funds if we use conversion funds for converting our governmental funds to that entity-wide concept of governmental activities. At the inception of the lease in the governmental fund, the leasee would record an expenditure and another financing source, basically to recognize the inception of the lease at the same amount, that net present value of the future lease payments. Subsequent to that, in the governmental fund, the lease payments would be accounted for consistent with principles for paying debt service on long-term debt, recognizing principal and interest expenditure when matured and payable. So that's both the economic resources and governmental funds on the lessee side. For the lessor, there is no difference between current financial resources measurement focus and economic resources measurement focus for recording the lease receivable and the deferred outflow. We would record those both in our governmental funds, if those are impacting a governmental fund, as well as in the government activities at the entity-wide level. GASB may change this with their reporting model project in the future. However, for now, until we may see something from that, we would not expect to see a difference between accounting for a lessor as a lessor in a governmental fund versus accounting for that at the entity-wide level. So that's the accounting at the inception of the lease when we sign the lease. What about accounting for that in subsequent years? In subsequent years, the lessee will amortize the intangible asset over the lease term unless the useful life of the asset is shorter, in which case you have to question why you entered into that lease or that contract in the first place if you're paying for something long after the useful life is expired on that. You'd reduce the liability by the principal amount paid on the lease and recognize interest expense for the remainder. As Anthony will note, if the lease does not contain an interest rate, you'd have to determine an implicit rate and apply an implicit rate to that lease transaction then. In governmental funds, you'd recognize both the principal and interest paid on the lease as an expenditure, and there is no amortization expense of the intangible asset to recognize in the governmental fund. The amortization of the intangible asset, demonstrating the use of that asset, is only recognized at the entity-wide level and not in a governmental fund. On the lessor side, you're going to continue to depreciate the asset that you still own, which is a big difference between the FASB guidance and our guidance. On the FASB side, if you're the lessor and you lease a tangible asset, you remove that asset from your books. On our side, you keep the asset on the books because you haven't effectively transferred ownership. You still own the asset. So you continue to depreciate the asset on the lessor side, but then on the lessor, you reduce the receivable by the principal amount of the payment that you received, and then recognize interest revenue for the difference. The deferred inflow would be reduced and revenue would be recognized over the lease term then in a systematic and rational method over the life of the lease. Again, please don't shoot the messenger. This is what GASB has come up with, and I think it is pretty reasonable guidance when you consider the fact that they're trying to account for what is now a long-term liability under a non-cancelable contractual arrangement. That's the accounting. What about the note disclosures? Because we all know that GASB has never met a note disclosure that they did not like. As you can imagine, there's a lot of disclosures then related to the leases. First, on the lessee side, GASB 87 requires a general description of the overall leasing arrangements. The general description would include the basis, terms, conditions on which variable payments not included in the measurement of the liability might be determined, or the existence of different terms and conditions or residual value guarantees provided by the lease that aren't included in the initial measurement of the liability. We'd also then disclose the total amount of leased assets by major class of the underlying asset and the related accumulated amortization. And we have to show changes in those in that note that we have on capital assets. So in addition to capital assets, we show the changes in our leased assets in that note as well. We have to show the amount of any outflows of resources recognized for the period for any variable payments. Most importantly, as you see in that next bullet, just like a long-term liability, we have to disclose principal and interest requirements to maturity, first for each of the next 5 years individually, and then in 5-year increments thereafter until the maturity of that contractual arrangement. In addition, if we have commitments under leases that have not yet begun because the asset's not constructed yet, we would need to disclose that. And then any components of any net impairment losses recognized on leased assets during the period would also need to be disclosed. So that's the disclosures for the lessee. Disclosures for the lessor, on the other hand, are just a little bit different. First and foremost, the lessor would have to disclose the general description of the leasing arrangement, which again is very, very similar to what we had on the lessor. Basis, terms, conditions on variable payments, and anything else that's not included in the measurement of the lease receivable. Next, we'd have to disclose the total amount of inflows of resources, such as lease revenue and interest revenue, if not separately displayed on the face of the statements. We also disclose the amount of resources recognized for variable payments or other payments, such as residual value guarantees, that weren't included in the original measurement of that release receivable. Last but certainly not least, any terms or conditions of options by the lessee to terminate the lease or abate payments if we've issued debt for the principal and interest payments, we'd need to disclose that as well. There are also specific disclosures required for leases of assets that are investments, certain regulated leases, subleases, sale leasebacks, and lease leasebacks. We're not going to cover those because they won't apply to most of us, but if you do have questions on those, please submit those to Anthony and I, and we'll be happy to address those at a future point in time for you. Also, if the lessor's principal ongoing operation consists of leasing assets to other entities, then you would have to disclose a schedule of future lease payments that is coming to you over a 5-year period, as well as for the duration of the engagement in 5-year increments. You do not have to do that, though, if your principal operation is functioning as a lessor. So for most of us, we will not have to include that last disclosure. Implementation, oh gosh, where to begin? You all have a Herculean task ahead of you, especially for very large decentralized governments such as colleges and universities, very large county governments and other entities. We can't encourage enough. You really need to get your arms around these transactions as early as possible. Remember, we apply this pronouncement retroactively at the start of the fiscal year that we implement the pronouncement. GASB 87 requires us to restate all prior periods presented, or if it's not feasible to restate all prior periods, then, especially for you all that prepare comparative financial statements, such as community colleges in Wisconsin, Illinois, and Iowa, you'd report that change as a cumulative effect in the current year opening net position. And those of you that don't report comparative financial statements, that's probably how you're going to effectuate the change as well. The biggest issue facing most of you is trying to get a handle on all these lease agreements that are executed by your governments. Most governments have a good handle on what used to be called a capital lease, due to the previous requirement to report the long-term liability and the related capital asset from the lease. However, most operating leases, which oftentimes may not come before our boards for approval because they're below a purchasing threshold on an annual basis, and because they're not purchases, they're just a right to use an asset, may never go before our boards for bidding or approval. So therefore, we don't have our usual source documents to turn to, which is reviewing board minutes for approval of these types of transactions. That's why it's really imperative that you start now by inventorying all leases that are in existence throughout your organization. Now you're probably saying, well, Fred, we've got that Pitney Bowes lease over here, we've got a copier lease over here, and individually, none of these leases are really material. So can't we just say that it's immaterial and not apply GASB 87? Well, both Statement 87 and the implementation guide noted that from a materiality standpoint, you need to assess materiality at the opinion unit level, and you have to aggregate all leases as a lessee and all leases as a lessor in that opinion unit, and then apply your materiality concept. So you can't apply it to individual transactions. You need to aggregate all the transactions in that opinion unit and then apply the materiality concept. That brings us to the conclusion of the focus of GASB Statement 87. Now we'd like to walk through some specific examples for you, from examples that we actually took from some of our clients as to how this may impact you all and how to apply these pronouncements. And for that, I'm going to go ahead and turn it over to Anthony now.
Thank you, Fred. Well, Fred's done gone through and done a really robust job of giving us the outline of what some of the requirements are of GASB Statement 87 and a lot of the technical components behind that. But at this point, it's really, I think, important and relevant to go through and look at some practical examples, as Fred noted. These are examples that we've seen in practice for that, some of which hopefully will be very relevant to you and your organization, so we'll be able to look through those. So our first example that we're going to look at here is a park district lessor leasing space in their district-owned recreation center to another unit of government, a special recreation district, this is our lessee, via a lease agreement. In our example here, the lease agreement is for a period of 30 calendar years. It's non-cancelable by either party. Calls for 30 annual payments of $20,000 due on the first day of the year, with an additional $20,000 that's due upon signing of the lease, total for $620,000. As Fred noted earlier, when you don't have an interest rate, you do have to assume an interest rate for that. In this case, our lease does not contain one, so a rate of 2.5% has been assumed, giving us a net present value of future lease payments of $418,000. In this case, the lease does not transfer ownership of the center at the end of the lease agreement and does not contain any options for extensions. So what we then have to do is go through and answer some key questions for that. First, is this a lease as defined by GASB statement number 87? And two, why or why not? If we determine that this is a lease, then we're going to go through how it should be reported from both the lessor standpoint, the park district in this example, as well as the lessee standpoint, the special recreation district. Now remember the definition of a lease that we went through earlier in the presentation. A lease is a contract that conveys control of the right to use another entity's non-financial asset for a period of time in an exchange or exchange-like transaction. So in this case, do we have a lease? Yes, we do, because the agreement in place conveys control of the right to use that center, or use the space within that center for that's the underlying non-financial asset for a period of time, 30 years in this example. It's an exchange-like transaction. The payments are happening at the beginning of the lease, the inception of the lease, as well as over that 30-year period. How do we report for this from the lessor standpoint? So from the park district standpoint at inception, and our governmental funds, and the acronyms that we have here are current financial resources measurement focus on modified accrual basis of accounting. We're going to report our lease receivable of $418,000, the net present value. We've also received $20,000 up front as part of that, so that's cash in. Our offset is a deferred inflow of resources, credit balance or credit there for $418,000, again corresponding with that lease receivable amount, and recognizing $20,000 in lease revenue for that. As Fred noted in the governmental activities, there's no conversion entry for that. This flows directly into the governmental activity, so it's the same reporting at both the current financial resources measurement focus and modified accrual basis of accounting as it is as the economic resources measurement focus and full accrual basis of accounting. In subsequent years, payment received for year one in this case, again looking at our governmental funds, same measurement focus and basis of accounting for that. Our deferred inflow, we have an interest piece to this. Our deferred inflow is reduced by $19,510. We've received $20,000 in cash for that. Our lease revenue, $19,510, again agreeing with the deferred inflow amount as well as the lease receivable reduction. Our interest component, again, based on that assumed interest rate of 2.5%, equals $490 of interest in year one. And then finally reducing that lease receivable. Again, no conversion entry on that piece of it. What about from the lessee standpoint? So we're going to go through and look at the lessee standpoint, and it's because we have both a governmental entity in both the lessor and lessee standpoint in this circumstance here. So again, we have our lease. It still meets the terminology and the definition of a lease under GASB statement 87 for that. So from a lessee accounting standpoint at inception, again, looking at our current financial resources measurement focus on modified accrual basis of accounting, we have our leased asset and expenditure of $438,000. So that's our $418,000 net present value, plus the $20,000 initial payment that was reported there. The cash outflow of $20,000, as well as other financing sources for $418,000 for a lease credit there. Our governmental activities then, so in this case, we do have conversion entries that are affiliated with this. We're going to report that intangible asset to right to use that center for $418,000 at the net present value. Our other financing source, this is offsetting, so this is the conversion piece of that, our $418,000. We're going to report the lease payable, and then finally the conversion piece of that expenditure for the leased asset of $418,000. Again, looking at this from the lessee standpoint at inception, what does it look like in subsequent years? In our governmental funds, we'll have this broken down by principal paid as well as interest paid there. So again, our $19,510 paid in principal. our interest of $490, offset by our cash payment, our cash outflow of $20,000. On the governmental activities, the impact then of those conversions. So again, reducing our lease payable, eliminating that principal paid on our conversion entry there. And then the other piece new under GASB Statement 87 is the amortization of those amounts. We have to report the amortization expense of the lease as well as the accumulated amortization. GASB 87 tells us that we're going to do that using that net present value figure, again looking at that 30-year useful life in this example. So that gives us a $13,933 amortization expense on that government-wide level. In another example, this may be relevant to many of our participants today. If you lease space on a water tower to a private company to place a communications device on the tower. In this case, the agreement is for a period of 5 calendar years. It's non-cancelable by either party. The lease calls for 5 annual payments of $25,000 due on the first day of the year for a total of $125,000. Again, in this particular contract, there's no interest rate provision, so we have a rate of 2.5% that we've assumed here, giving us a net present value of $116,150. And the lease does contain one option for a 5-year extension. However, the village does assume that that will not be exercised. So again, asking ourselves our key questions here. Is this a lease as defined by Statement 87? Why or why not? And how should that be accounted for by the village? In this case, again, we do have a lease because we are conveying control of the right to use a village water tower. This serves as the underlying non-financial asset for a period of time, 5 years, in an exchange-like transaction with this outside party. At inception, we're going to report, in this case, we're only the lessor, so we're not going to have any lessee component to this because we have a non-governmental unit as the other side of the party for this. So our transaction is to report that lease receivable for $116,150, again, at the net present value, and our deferred inflow of resources for leases for the $116,150. Again, no conversion affiliated with this part of the entry. When payments received for year 1, deferred inflow, reducing that by $24,390, the interest piece of that, or the interest piece factored out of that. We've received $25,000 cash for that. Our lease revenue of $24,390. Our interest revenue, again, based on our assumed interest rate of return of 2.5% of $610. And the lease receivable reduction of $24,390 there as well. Again, governmental activities on the lessor standpoint, no conversion piece for that. So what if we change the terms a little bit? What if we had a situation where we had a payment in full, our $125,000 was received at the inception of the agreement? And we have to ask that same question. Is this a lease as defined by GASB Statement 87? Yes, the agreement still conveys control of the right to use that water tower, again, for a period of time in an exchange-like transaction for that. However, in this case, our cash, we're going to receive the cash of $125,000 and the deferred inflow of resources of $125,000 as well there. So the net present value impact is eliminated from that. Again, no conversion entry there. On the lessor standpoint, then looking at this in year 1, we'd have a deferred inflow, $25,000 reduced there. In this case, again, looking at that same interest rate of return for subsequent years on that, we'd have $24,390 of our lease revenue, again with $610 of our interest revenue there as well.
Anthony, it's interesting that in the implementation guide, GASB did have a question specifically on cell tower leases. And be very careful when you read that question and apply the answer to that, because the question is structured asking not about putting a cell tower on top of your water tower or on top of your existing communication tower if you're a 911 facility or anything like that. Instead, the question was focusing on, well, if you're leasing the land and letting them put up a cell tower on your land, would that apply then? So be very careful how you read that question in the implementation guide for those of you that will pick up that implementation guide. So
great point. Thank you, Fred. So let's look at it if we are the lessee in a transaction. So another example that may be relevant to many of our participants today. In this case, we're leasing 3 squad cars from a vendor or auto dealership. The agreement is for a period of 3 calendar years, again, non-cancelable by either party. Our lease calls for 3 annual payments of $20,000 due on the first day of the year, totaling $60,000. No interest rate assumption here. We see a theme with these. We just like assuming interest rates here and doing net present value calculations. So we've got 3% for our annual assumption there, giving us a net present value of those future payments of $56,570. In this case, this is an important component to this example. The lease does not transfer ownership of the squad cars at the end of the agreement, and our squad cars have a useful life of 5 years. So again, asking our key questions: do we have a lease? Why or why not? And what if circumstances change? What if we transferred ownership at the end of the 3-year period? We'll go through an example. We'll go through and kind of figure out what that looks like as well. So the overarching question, again, yes, we have a lease here. We've got the right to use the squad cars, an underlying non-financial asset, for a period of time in an exchange-like transaction for that. So from a lessee standpoint, where we are in this case, we have an expenditure for the leased asset of $56,570, again, using the net present value calculated figure. Our other financing sources, or source for $56,570 for our leases there. Now you may think, Anthony, that's pretty similar to what we've seen in the past for a capital type lease for that. And it is. There are some similarities in that incorporated into the guidance under GASB Statement 87 for that. Where it gets different is on the governmental activity standpoint. We're now going to report this intangible asset, the right to use those squad cars. The next piece, next 2 lines, are other financing source, and our expenditure piece there, the conversion component of our entry. And then finally, our lease payable credit there at the $56,570 there. So at the end of the day, on our governmental activity standpoint, we have our intangible asset, we have our lease payable. We make our payment for year 1. We have principal paid for leases, $19,420. Our interest paid, $580. Our total cash outflow at $20,000 on the fund level. Governmental activities, reducing our lease payable, again by that $19,420, eliminating that from a conversion standpoint. And our amortization expense, using the net present value of $56,570 over that 3-year term, gives us a net an amortization in year 1 of $18,857. Earlier we asked what's the impact would be if the lease transferred ownership of the squad cars to the village at the end of the 3-year period, and the squad cars have that 5-year useful life. So in this case, answering our question, do we have a lease as defined by GASB Statement 87? And in this case, no, we don't. We have an installment purchase contract, as Fred noted earlier. Ownership's transferring as part of this, so this no longer falls under the guidance under GASB Statement 87 for that. So in terms of how we report for that information, purchase accounting for installment contracts, expenditure for capital outlay of $60,000 in this case, and other financing source for the installment purchase. On our governmental activities, as part of our conversion process, we'll have our squad cars that we've increasing our capital asset there for $60,000. Again, our next 2 lines, the other financing source and the expenditure, take care of reducing or doing our conversion entry components for us there. And then finally offset by that installment contract payable. In year 1 for that, our principal paid of $20,000, interest of $600 there, with cash outflow of $20,600. On a governmental activity standpoint, again, reducing our installment contract payable by $20,000, the principal component, our principal paid, reduction of $20,000 there. And then finally, our depreciation expense. This is now based on a $60,000 asset with a 5-year useful life for that. So in this case, we'll have an annual depreciation of $12,000 a year for that. Now, we've really only scratched the surface of what's covered under GASB Statement 87. So echoing the earlier comments, as the implementation guide comes out in 87, we strongly encourage you to spend some time looking at that information. As always with GASB's implementation guides, a wealth of information, and they're really another great tool in addition to the standard itself and the examples provided within the standard to be able to effectively implement this information. Topics that we don't have time to cover in a 1-hour webinar today, some of the items listed here, but we've really tried to highlight the key points of what's going to impact you on an initial basis under GASB Statement 87 for that.
And Anthony, we did have an additional question come in, if we have time to answer those now. First question is, which statement do we follow if we have a cancelable contract? Nearly all of our contracts are cancelable. Well, again, you have to look at it, is it cancelable because it has a fiscal funding clause built in? GASB 87, just like NCJ Statement 5 said, ignore the fiscal funding clause unless your intent is, and you have a reasonable expectation of exercising that fiscal funding clause. So the majority of leases that we enter into, by law are non-cancelable because of that fiscal funding clause. So that's why GASB said from an overarching standpoint and a substance over form standpoint, you have to kind of ignore that in determining if it's not the terms of the lease. So in that instance, I would say that if it's cancelable because of the inclusion of that fiscal funding clause, that would not apply. In addition, the implementation guide, question 4.18 in the implementation guide, says that if the lease contract allows only the leasee to cancel the lease at any time, are the cancelable periods excluded from the lease term? And again, GASB said you have to look at it from a substance over form standpoint. Even though it's cancelable at any time, if the intent is that you're going to be leasing this asset for a long-term period and you have no other options for acquiring another asset or to derive something to provide services to your constituency, from a substance over form standpoint, even though it's cancelable at any time, GASB would say it's really non-cancelable under this pronouncement, and therefore you could not you would have to apply GASB 87 to it. So very, very good question there. And then the follow-up to our previous question, they said we intend that with the 12-month leases, they intend to lease it as long as the tenant wants to leave, but there'll be no renewal options. Instead, we will enter into a new agreement each year. And again, GASB said it's clearly in the implementation guide from a substance over form standpoint, we'd have to treat that as not a series of one-year leases, but instead include all those terms within the overall lease calculation. Great questions.
And as you can see, just from a few questions standpoint, the substance over form takeaway from this, as well as really being able to start gathering this information if you haven't already on GASB 87 and working through these questions on the front end for that will make the implementation for you on your effective date all that much smoother. With that, that concludes our webinar for today. Thank you for your attention. And again, please feel free to reach out to Fred or myself with any follow-up questions that you may have. Our contact information will be included in the survey that you received, along with the recording of today's presentation as well, and the PowerPoint slides. Again, please complete the survey for CPE credit as well, and we'll process that certificate for you. Again, thank you for attending our webinar. I look forward to seeing you later this year for our GASB 84 webinar coming this August, hoping to do these on a quarterly basis going forward for you on that. So do look forward to seeing you then. Hope everyone has a great afternoon. Take care.
Thank you all.